All right, so good evening, everyone, from wherever you might be joining this evening. Please, if you can hear me, let's have those emojis to show that we are all right. So, welcome to another session of tutorials with Next Gen Professional Associates. We are glad to have you on board. And this is a lecture for Strategic Business Reporting SBR. My name is Mr. Ebenezer. I love to be called Mr. Ebenezer. And I'll be taking you through. We are going to be two lecturers that will be taking you through the SBR, this diet, and so that we can have a lot of coverage, and then we can quickly finish on time. You know, May diet is one of the shortest diets, so let's just keep it going that same way. For those that are joining new, we welcome you. Those that are coming again, we welcome you. My prayer is this will be the last time you will write these exams and that you are going to pass your exams. So that being said, I quickly want to go through what we are. That's the syllabus, as it were. Look at the overview of the syllabus. What we are to cover in SBR for this diet, and we have the grid here A to G, and we have the grid A that talks about the ethical issues in and regulatory framework of strategic business reporting. That is the ethical issues in business reporting, as well as the regulatory framework of strategic business reporting. And then we'll look at reporting entities' performance to stakeholders. Here we shall be looking at some standards like IFRS 8, operating segment, revenue from contracts, as IFRS 15. We'll be looking at operating lease, IFRS 16. We'll be looking at asset held for sale, IFRS 5, and so many other standards under this performance, entities performance to stakeholder. That's the report, as it were. And then the major one, which is the group C, and that's the group C rather, and that's talking about the group financial statements. So at this level, it's expected that you should know how to consolidate the group financials. When we talk about the group, that is an entity that has a subsidiary or has a sub-subsidiary, as well as an entity that has subsidiary plus sub-subsidiary plus associate plus joint venture. And so at this level, you are to know how to consolidate their accounts. Also, the group D will be looking at analysis of financials and other reports to appraise the entity's financial performance and position. In other words, we shall be looking at what we call the ratio analysis and the likes. And then grid E talks about sustainability, integrated reporting. Grid F talks about the impact of changes and potential changes in accounting regulations. And then the last one talks about the other current developments in and beyond financial reporting. So it is expected that you should be able to align yourself with all of these and get yourself prepared, and so that you can pass SBR. One thing certain is this: SBR might look heavy, might look I don't want to use the word hard. But I want to tell you that in this class, we shall be demystifying it and making it look simple for you so that you can have the best of time. Please, the rule is very simple. When you are not called to speak, don't speak. Let's mute our mic, mute our videos. And then let's come with our jotting materials. Very, very important. Our barrels jotting material to put something down. Today, we shall be starting with the grid A. Like I said, we have two lecturers that will be taking us. I will take you this grid A, and then we'll look at how we'll be taking you the other lectures. I welcome you one more time, and I hope we're going to have the best time together. So let's really dive into what we have today. Grid A, ethical issues and regulatory framework in strategic business reporting. You see, when we talk of, let's start with the regulatory framework, then we mirror down to the ethical issues, and then position ourselves with the conceptual framework. So when we talk about regulatory framework or strategic business reporting, you should understand it that it simply means an entire systems of laws, institutions, standard guidelines, pronouncements, and all kinds of mechanisms that have been put in place to govern how financial and non-financial information is to be prepared, presented, disclosed, audited, as well as interpreted for decision making. In other words, where there are no regulations, there will be no sin. If there are no rules, there will be no sin. You just prepare your way the best way you can as an accountant and then move ahead. But then with the regulatory framework in place, it gives us an overview of what is expected of us, what we are to align with when we are preparing and presenting, as well as disclosing, our financial information. So at this level, it is called strategic business reporting, not corporate reporting, not financial reporting, strategic as it were, because every of your report, as it were, is going to be used for strategic business decision. And so understand that without adequate regulations in place, we may miss it. We may just communicate anything we like, and that will not enhance quality decision making. So the regulatory framework, as it were, is a whole lot of system of laws, standards that are being put in place to ensure that whatever we are putting out as financial reports align with the major requirements as it were. Please, you can see my screen, right? All right. Please, if you can't see my screen, that means your network. And please check through with your network. Thank you. So what are the major cross of strategic business reporting in terms of regulations? That is to say, you should understand that SBR, as it were, goes beyond your normal routine of financial reporting. You are communicating an entity's performance. You are communicating the position of an entity. You are communicating the prospects, the risk available within an entity. And so when you are doing all of these, rendering stewardship, giving accountability, you are protecting the stakeholders' interests, and then above all, sustaining the public interest. When you are doing all of these, should be something that will guide you adequately well and to future. And that's the essence of regulatory framework. So when we say regulatory framework, nobody will ask what is regulatory framework, but just understand that it's a whole lot of system put in place to govern how financial and non-financial information should be prepared and presented, as well as audited, interpreted for decision making. And so moving ahead, we have various levels, which is known as sources of regulations, as it were. So we have about 4 layers also put to play. So we have the structures. We have regulatory frameworks, in 4 structures. We have the international level, or the sources from international levels. We have that of the national, that is according to your country where you are operational. And we have that of the professionals. This is the one issued by the professional bodies. And we have that of the industry on the institution, as it were. So the international regulatory framework is a whole lot of system that is being governed by the International Accounting Standard Board. In other words, the regulation that is provided by the International Accounting Standard Board is the first layer, the first level of regulation. And that talks about the accounting standard, as it were, the standard that are being used, that have been applied in the preparation and presentation of financial statements. We have quite a number of them. And so we have the standard, quite a number of them, like I said. And then we have the conceptual framework, which is more or less like the manual for the standards. When you buy your TV, your phone, your gadgets, or whatever, they will tell you there is a manual. So the conceptual framework is more or less like the manual that guides how to prepare and present financial reports. And so the International Accounting Standard Board is the regulator, and then what they provide or what they give to us as accountants, as professionals, as strategies are what we call the standard, the accounting standard, the accounting principles, and it governs how each of the items we are putting down in the financial statement, how applicable it should be. And then we have the conceptual framework. Like I said, We have quite a number of these accounting standards. We have IS1 that talks about presentation of financial statement, and of course that will be repealed, and another standard will come in full-fledged come 2027 1st of January, and that is known as the IFRS 18 that talks about the presentation and disclosure of financial statements. So that is that for that. So we have quite a number of them. IS2 talks about inventory. IS 16 talks about property, plant, and equipment. And then we have IFRS 16 that talks about lease. IS 40 that talks about investment property. IS 12 that talks about income statement. And quite a number of them. Very, very voluminous. And these are the standards. That's why they call it accounting standard. They are like principles. They guide the way and manner by which we prepare and present these financial statements. And then, and that being said, we have also the national the national what is it called? Okay. Before we move ahead, we have other bodies that also support these accounting standards. We have the International Financial Federation of Accountants. You know, they provide a code of ethics for professional accountants. We have the International Standards on Auditing, that is IASB, and then we have Public Sector Accounting Standards. They also are the international levels of bodies that support the accounting standards as to how we should use it when we are preparing our financial statements. We equally have the International Organization of Security Exchange Commission. You know, they are to protect the investors, ensure fair and efficient market, and reduce every form of systemic risk, as it were. And so also we have the National Regulatory Framework. Remember, we are talking about the layers, the levels of or sources of regulations. In your exam, you can be asked what are the sources of regulations, or who are the regulators, or what are the levels of regulation. So the first levels, it has to do with the international levels, and then the second level has to do with the national level. Like I explained earlier, the international level, the one that they are being administered, or the regulators include the International Federation of Accountants, IFAC. We have International Accounting Standard Board, and then we have that of the Stock Exchange. All of them put together, they form the basis as to which regulations are being governed internationally. Then we have the National Regulatory Framework in Nigeria, and then the major regulators of the National Regulatory Framework is the Federal Reporting Council of Nigeria. This Federal Reporting Council of Nigeria, they are the apex regulator when it comes to regulation of accounting practices and the ways and manner by which professionals are being guided as to how to prepare and present financial statements. They are the apex. They are the body, and so they have quite a number of things they are to do. Amongst them are the following: they enforce accounting on the auditing standard. That's number one key things that they do, one of their core functions. They enforce the practice of accounting. Very, very important. And then number two, they ensure compliance with IFRSs. That is to say, they are the one to tell us, okay, we are to adopt this IFRS, and they are the one that will ensure that we, of course, stay put with all of this IFRS as it were. So that is that for that. Then number three, they monitor financial reporting quality. In other words, they ensure that whatever it is that we are putting down in those financial reports adequately measure up with what the public can utilize. And then another key function of theirs is that they register professionals and the firm. For instance, if you are a CFO in any of the organization, you are allowed to just apply to FRCN as a member, and they give you the license. You can easily sign and authorize any of the financials as it were. You understand it now? So that is that for that. They also impose sanctions for non-compliance. Where you don't comply, they can impose sanction on you. So these are their key major functions, what they do majorly. So please take note of this. They can as well tell you, give you a scenario-based questions, and then they will tell you the simple thing to they will tell you that you should tell us what are the key functions of the Financial Reporting Council of Nigeria. Understand that at your level, your question will be scenario based, and so what is expected of you is that you should be able to understand what the question is saying in a layman way, understand it clearly, and give the answers to it your best way. Huh? So that is that for that. So we have the Financial Reporting Council of Nigeria as part of the National Regulatory Framework. And then we have the Corporate Affairs Commission, that is the CAC, that deals with the Company and Other Matter Act, that governs how a company should operate in Nigeria. The CAMA 2004 tells us the statutory financial statement, that is the prescribed the kind of financial statement that the company should prepare and present. They tell us the deadlines for filings. In CAC, for instance, they say that every company should file their returns annually. So they tell us the deadline. They tell us the content and the format of the company's of account. They tell us the director responsibility, the disclosure that is required. For instance, it is expected that the director, amongst their responsibilities, that they must give a report annually, and their report must contain the numbers of directors and in the current year, the profit that was made in the current financial year, the dividend that was declared, and a whole lot of issues. If there are dividends, if there are new issues of share, they will tell us in their reports. And the failure to comply to all of this also attracts sanctions. So all of this put together, they also have their sections. This CAMA have a lot of sections from 370, section 370 to section 500 to 700. You have a whole lot of what is expected of each of the company. So that is also the second regulators when it comes to the National Regulatory Framework. And then you have the Stock Exchange, this Security and Stock Exchange Commission, another layer under the National Regulatory Framework. The Stock Exchange, they are also there, and their duty is to regulate, public listed companies, as well as in the market, the capital market operators. That is their major duty. So they focuses on protection of the investors and ensure transparencies, as well as continuous disclosure of obligations. So that is that for that. These are the key things, the key bodies rather, under the second level, which is the national level of regulators. Please note all of these. It is very important for you to note all of this. Then you have the third layer, which is the industry-specific regulators. That is the institutions, the industry where professional accountants work every now and then. And so you have these regulators, for instance, the central banks, they govern banks and other financial institutions. So these industry-specific regulators, they provide what we call the guidelines. The guidelines as to what is expected of each of the entities or the professionals within these entities to prepare and present a quality financial statement. So we have the Central Bank of Nigeria that governs the banks and financial institutions. We have the NICOM, that is the National Insurance Commission, that governs the insurance company. And then we have the PENCON that governs the pension funds and the like. So we have various regulators. They are also there. For instance, the NRS in Nigeria Revenue Service, they tell us more about taxes. They give us the laws, the guidelines as to what is expected of us, and a whole lot of them like that. And so understand that this is also another layer of regulation. So they provide what we call guidelines, as it were. And so we also have another level of regulation, or another source of regulation, as it were, and that is the professional bodies like ICANN, ANAN, CIBN, and the likes. So they provide what we call a framework of ethics, what is required of you as a professional to guide you in a discharge of your duty. They provide the ethical enforcement, that is minimum enforcement that is required. The minimum ethical standard that you are supposed to operate as an accountant is being enforced by this institutional government. And then they also help us, for professional development. You understand? They also dish out disciplinary mechanism. They give out all of these disciplinary actions to any hiring professional as it were. So these are their key functions, and these are the key layers under the national regulatory framework. So let me recap again. We have the sources of regulations, which can be also defined as the layers of regulation. We have the international, and then we have looked at quite a number of bodies under that. We have the IASB, IFAC, IOSOC, like that. Those ones, they are the one that governs how well, of course, the international structures of standards that we are to uphold and we are to use every now and then. And then we have the national structure. That national structure, I mentioned earlier that we have the FRCN rather, Federal Reporting Council of Nigeria, which is the upper governing body for professional accountants in Nigeria. They have the right to sanction, they have the right to monitor, they have the right to detect the kind of standards we are to follow, how we are to apply it, and the likes. And then we have the second layers, and that talks about the CAC that deals with Common Matter Act. And then we have the Security and Exchange Commission that talks about how publicly company and capital markets operator are to be regulated. And when we talk about the industry-specific regulator, also CBN, NICOM, PENCOM, all of these, they are also to give a guideline as to how all of these professionals, that is, we the professional, how we are to prepare and present financial statements. And then we have looked at the professional bodies, what is expected of us. So all of these are the layers of regulation. So we have 4 major layers. Don't forget, I said we have the international, we have the national, we have an industry or institution, and we have the professional layer. So these 4 key layers, they are the sources of regulation. They are the layers or levels of regulations that governs the accountant professionals in the way they prepare and present financial statements. So before we move ahead, any question? It's clear enough. Can I go ahead? Are we still together?
Go ahead, sir. We are together,
Thank you.
sir.
Thank you. All right. Thank you so much. So that being said also, please mute your mic. Let's look at the importance of regulatory framework. Why do we need regulation? What is the importance? What is the essence of regulation? Briefly, number 1, with regulation, the credibility of report is enhanced. That is, enhancement of a report. With regulation, the credibility of the reports are enhanced. Imagine that there are no regulations or no regulator. How will the report look like? It means that anybody can just prepare anything and present anything as they like it. So with regulation, the reports are well enhanced for credibility. And then number 2, it prevents misleading financial statements. In other words, the people in any way, the financial statement that we are preparing, will be well captured. In other words, the preparer will not present what will be misleading to the members of the public or the users of the financial statement. Number 4, it protects the users of financial information. And then number 4, it ensures accountability and stewardship. Number 5, it builds investors' confidence. So all that you need to know in all of this is understand that the regulatory framework enhances the credibility of the report. That is, the credibility of the report is enhanced. It also prevents misleading financial statement. In other words, it prevents window dressing, creative accounting. It prevents it. Without regulation, anybody can just do anything and just mess up the whole system. But with regulation in place, window dressing is prevented, creative accounting is prevented. And number 3, it protects those that are using those financial information that are being put in the business report. And then number 4, accountability is ensured. Stewardship is also ensured by the owners of the business, the director of the business. So the directors of the business, they become more accountable and they render quality stewardship. And then you have the last one, which is the confidence. Without the confidence level of the users, financial report that we are presenting will just be useless. In other words, if the financial report is being utilized, it means that, I mean, if the financial report will be utilized, it means the confidence must be enhanced. And that is one of the core importance of these regulatory frameworks. And that is all that you need to know when it comes to regulatory framework. So when we talk about regulatory, all that you need to know at your level is what are the layers of the sources, and each of these sources, what do they stand to enforce, what do they stand to develop, what do they stand to give to us, and the likes. And then the importance of regulation. And those are the things that we have discussed under this regulatory framework. So quickly, let's move to the ethical issues in strategic business reporting. Okay, you are raising your hand. You want to say something? Okay, let me go ahead then, if there is no other question. Ethical issues in strategic business reporting. We need to deal with this particular section so that we know that at least by now, once we are done with this section, you are done with 10% of what you have to cover for your exam. So ethical issues in strategic business reporting. When we talk about ethics, we are talking about the moral principles as well as the professional values and the code of conduct that professionals are to imbibe when we are preparing, presenting, interpreting, and using financial information. We know that as we are, as professionals, a lot of people rely on whatever it is that we give out there. And that is why it is important for us not to in any way, bring down the standards. We must uphold the standards. Very, very important. So ethics is critical because financial report influences the decision. Any financial report we are giving, they influence the decision of people that are to make decision. Equally, users rely heavily on the integrity of we that are preparing these financial informations. And then the public interest always must outweigh our private gain. So therefore, the essence and the need for us to imbibe quality ethical principles in the way and manner we discharge our duty. So what are the fundamental ethical principles that we are to uphold? Number one, we have 5 of them put together. 5 of them put together. I can uphold this international financial accountant conference. Now, for instance, they gave us the 5 code of ethics, which I can also upheld. And so we have 5 of them, and I give it an acronym which is called COPI, COPPI, copy, or copy anyone that you can call it. These principles, these 5 principles, they are the minimum requirements for every one of us to imbibe while we are discharging our duties. So we have them as follows. We have integrity. Let me just mention them. We have integrity, objectivity, professional due care, professional behavior, as well as confidentiality. So that is that for that. So number one, accountant, the integrity has to do with the fact that accountant must be honest. We must be straightforward. You must be truthful, very, very truthful in the way and manner you are discharging your duty. You must be honest. You must be straightforward. Don't cut corners. That is where integrity comes to play. When they are enticing you, consent thou not. Your integrity matters a lot. That's number one. Number two, objectivity. Be objective. Don't be biased. Don't allow any undue influence to override your professional judgment. Do not allow any undue influence to override your professional judgment. Ensure that your conscience is satisfied. Don't be put under any undue pressure. Do what is right, do what is correct, and move ahead. And number 3 is the professional competence and due care. This professional competence talks about you being competent, and that's why you are in this class, to learn more, to become a professional. You must maintain knowledge and have the skill that is required. Very, very important. And then confidentiality is the next one. And that talks about the fact as an accountant, you must be able to keep information lip sealed. In other words, don't disclose information without the right authority and the legal requirement. And then the last one, which is professional behavior, it means that you must comply with the law. You must comply with the law in all material respect. Avoid actions that will discredit the profession of an accountant. And these are the 4 key ethical principles that you must uphold as a professional accountant. Please remember the acronym COPID. Copy. C stands for confidentiality. O stands for objectivity. P stands for professional due care. And then the second P stands for professional behavior. And then the high there stands for integrity. Please take note of that. And I'm sure that with this, if they ask any question on this, you can deal with them. Now, what are the key ethical issues that are commonly encountered by professional accountants? Ethical issues commonly encountered by professional accountants. Number 1, we have the earnings management. Earnings management. Earnings management involves the deliberate manipulation of accounting estimates. The deliberate manipulation of accounting estimates or policy to achieve desired results. That's what we call earnings management. Example is instead of you to recognize the revenue this year, you did not recognize it, you delay it so that perhaps you will not pay tax, as it were. Like we are in a tax era now, a lot of earnings management may come to bear and may come to play. And so as a professional, you don't indulge in that. Delaying expense recognition. Instead of you to recognize expense in the current year, you delay it the next year. Changing depreciation method to boost profit. You have been using straight line method before, but because you want to improve your profit base, you now change it to the reducing balance method. All of these, they are what we call deliberate manipulation of the accounting estimate and policy. And all of this is not correct. Sometimes within accounting rules, this may be allowed, but it is not in any way professional. In other words, don't use it, don't deal in it in any way, because it will affect your faithful representation, the faithful representation of information that you are putting down on the financial statement. So that is number 1. Please, you can be asked to write short notes on the following earnings management. That is why I'm bringing this up now. Understand it, and that is that for that. So earnings management means a deliberate manipulation of estimates or policies to achieve desired profit figure. Number 2 is creative accounting. Creative accounting is different from earnings management. Creative accounting exploits the gaps that is in the standard. They look at the loopholes, the lacunas that are in the standard, and to present a misleading picture of the financial position and performance, while also remaining technically compliant. You understand me now? And so understand that no matter what you do, if it is against the standard, whatever it is that is against the standard is not ethical. So when we indulge in creative accounting, looking at the loopholes, the lacunas, and in the standards, and then you still want to remain compliant, that's what we call creative accounting. That is not ethical enough. Please don't indulge in it. A lot of our standards are not perfect, as it were. Not a lot. Some of our standards are not perfect, as it were. But don't look at the loopholes there to create unnecessary financial information, as it were. Number 3, issues or ethical issues where we encounter as professionals is misstatement and fraud. That is, deliberately misstating, deliberately omitting material information in the financial statement, or overstatement of asset or understatement of liability, intentionally falsifying the records. That's the simple meaning. All of these, they are the ethical issues that we encounter, which we must guard against as professionals. Then we have what we call the conflict of interest. This will occur when your personal interest interferes with your professional judgment. Take, for instance, your uncle owns a company and you are to go there and audit that company. Because your uncle is there, even if you see anything, you will close your eyes to it. Because there is also there is already what we call a conflict of interest. So please, these are also major issues that we face. Are we now going to say, as professional accountant, because our uncle owns a company, we cannot audit? There are safeguards. We look at all of these as we proceed. But then understand that it is important for you as a professional accountant to be guided, ethically guided. And that's why that 5 key ethical principles must be on your left hand. Your left hand has 5 fingers. Put each of them on the 5 fingers. So anytime you are dealing or anytime you are doing and discharging your professional duty, let these 5 principles guide whatever you are doing. Please take note. Then we have management pressures and intimidations. All of these, they are sources of issues that accountant faces in the discharge of their duties. But there are safeguards, like I said. These things will happen. They will create threats to you, as it were. But then there are safeguards to it. But before we look at the safeguard, let's look at the threats to all of these ethical principles of professional accountants. Number 1, we have what we call the self-interest threats. All of the threats that you will face in discharging your duties are in these 5 threats headings that I've put down here. And I also have an acronym for it, and the acronym is what I call SAFIS. SAFIS is the acronym that I use. SAFIS. SAFIS, that is SAFIS. SAFIS. The first S stands for self-interest. The second, the A stands for advocacy. F stands for familiarity. I stand for intimidation, and the last S stand for self-review threats. So service. Why I choose the word service is you always remember that you have to service your car, or if you don't have a car. If you don't have a car, you are going to buy a car. So you always remember that you have to service your car. So this servicing of your car simply means you have to service your ethical principle. You understand me now? So you have to service your ethical principles. The ethical principles are copy, Abi. What you copy from ICANN: confidentiality, objectivity, professional due care, professional competence, as well as integrity. So what we service, that what you copy from ICANN is what I'm putting down here. So we have it as a service. Self-interest threat. What is self-interest threat? Self-interest threat means that you already have interest. Let's use an example so it will be very simple. The example I used earlier. Your uncle owns a business, and you have to go there to audit them. There is no way you will audit them professionally, because you will see things and you will not be able to report it the way it is. That is self-interest. So you already have an interest in a particular jurisdiction, and there is no way you can do it well. Take, for instance, also, your uncle owns a company, and then now you are brought in as a CFO or as a professional accountant in the organization. The uncle will tell you that, look, this is a family business, so you have to do things so that things will work well. It will be a threat to you in upholding the ethical principle. Then we have the familiarity threat. That is, you are too familiar with the whole work. As an accountant, some of you now, you have been in your workplace for more than 5 years, 6 years, 7 years. You're already used to the system. People are familiar to you. And so if they are familiar with you or you are familiar with them, it will always affect your professional judgment. There is no way to not affect it. And that's why, in my own little life, I don't like working in a place more than 3 years. 3, 4 years, I think I should be done with you. And the essence is I don't want to get familiar with you to the extent that I won't be able to discharge my duty in with utmost due care. So familiarity will always bring in what we call compromise. And then intimidation. Intimidation is just the way it is. Your boss will intimidate you. Or that thing, change the figure. We must make profit this year. Don't you want to share bonus? You want to share bonus now. So they will intimidate you. If you do not do this thing, this is what will happen to you. All of these are what we encounter every now and then. And then we have advocacy threat. This has to do with litigation. When maybe your client or your company where you are working with, they have to summon you to the court, and you have to go there, and you cannot go there and tell lies. So the question now is this: your company where you are working for, where you are earning your daily what is it called now? Your life income, the income that you are using to support your life, where you are earning it. They took them to court. You are the CFO or you are the chief accountant there, and then you are expected to come and testify against your company where you are earning your daily bread. What will you do? Will you go and advocate against the company or for the company? That's a threat to our ethical principle. And then you have self-review threat. You are the chief financial officer or an accountant. You are the one that prepare the account of the company, and you are also part of the team of those that will audit the company. There is no way you will not close out to certain errors that you see in the financials, and that is what we call self-review threat. So self-review threat means you are auditing, you are examining, you are evaluating the work that you have already done by yourself. So all of these are what mirror down the threats that we can see in our day-to-day activity as professionals. And so what will always help us is to understand our principles, copy it, and then surface it with these threats. There are safeguards to all of these threats. And the safeguard are what we will be looking at next. What are these safeguards? Now look at it this way. When you are faced with any threats, always carry out what we call an independent review. An independent review. In other words, identify the major threat that is facing you. Is it an intimidation threat? Is it a self-review threat? Is it a familiarity threat? Advocates always review whichever threat that is face-to-face with you. Then, if you know that you cannot in any way undo that threat, the next thing you should do is to seek for professional advice. Seek for professional advice from those that have been in the business, that have the integrity, not anyhow person. And then, if the professional advice cannot work, you should know what to do next. Either you resign. I'm just giving you a step-by-step approach as to how to mitigate threats when they come to you. Either you resign, or you ask them to change your office, or you ask them to, or you just do something that will not make you to compromise your standard. Also, one of the safeguards that we can use in workplace is a rotation of personnel. Don't keep people on the same job for a long time. It makes them there's what we call diminishing return. There's also what we call a learning curve. Every learning curve will get to a marginal state and begin to drop. And so when you keep people too long on the same job, they become familiar with it, and then discharging to the utmost point becomes an issue. Then another way to safeguard is to whistleblow. That is, blow the whistle in proxy, as it were. Tell the hierarchies, the people that are in charge, the people on top, anyhow you want to do it, but don't let them know it's coming from you. That's what I will always advise you, because you don't know who will come after you if you blow the whistle to the wrong hands. So don't blow whistle to the wrong hands. For instance, we have people that are blowing whistle to the EFCC. If you blow whistle to the wrong hand and they get to nab you, it becomes an issue. And then the last one is adhere strictly to the standards, no matter the challenge, no matter the threat. Adhere strictly to the standards, the academic standard and principles, as well as the ethical codes of ethics. Ethical codes of conduct. Please, these are the safeguards that I can give to you, as it were. Now, professional judgment and ethical decision when you are being faced with any ethical dilemma. Anytime you are faced with the threat, what are the steps that you are to take? The step-by-steps that you are to take in dealing with any of these threats. Number one, identify the ethical issue. I've said that before. Identify the ethical issue. Number two, consider relevant ethical principles that will guide you. For instance, now you are working in your uncle's place as an accountant. Your uncle walk up to you and say, look, you have to make sure that we declare more profit this year so that we can declare more dividend. Me, I'm the chairman. I have the highest shareholding in the entity. And you know that no matter how, if they declare dividend, the chairman who happen to own the highest number of shares will gain more. And there's no way the chairman will gain more that you as yourself will not, get something. You understand me now? So now, if your uncle should push this to you, I'm trying to lecture in a layman way so you understand it. And then, when you are to write your exam, you will write. All of this that I'm saying, it is when you get to the exam that you will remember a lot of them. That's why I'm teaching you in this layman way now. So your uncle have already given you, an overview of what they want you to do. Now you need to check through the threats that you are being faced here. Number one thing is, what is the ethical issue here? Is it intimidation? Is it self-review? Is it a self-interest threat? You need to look at it here. Is it familiarity? You need to identify what exactly is the ethical issue. And then the second thing that you have to do is now consider and evaluate it with the ethical principles that I told you. You should put them on your left 5 fingers. Let them be on your left 5 fingers. The copy, what you copy from ICANN as a ethical standard, let it be on your 5 finger. Check it with that principle. Which one can I apply here? Is it integrity? Will my integrity not be affected? My objectivity will it not be affected? Ask questions. Will my integrity not be affected? Will my professional due care will not be affected? The professional behavior that I'm supposed to uphold will it not be affected? So ask yourself those questions. And then the third thing is look out for the alternative. What are the alternatives that are available to me? Should I tell, for instance, the example we are looking at, should I tell my uncle I cannot do it? Should I tell my uncle I want to resign after another job? You look out for the alternative. All of these things that we are saying is this: always look out for yourself and to ensure that you uphold the ethical standard. Please, it is very, very important. And then number 4, apply the safeguards like I've mentioned: professional consultation, whistleblowing, adherence to standard, and the likes. And then the last step is whatever you are doing, always ensure that the public interests are protected. There's a saying in the Yoruba palace that if you throw stone to the market, you don't know if it will land on your own family member. So always act in public interest. You might be thinking you are doing your client a favor. At the end of the day, it is not so. Please be careful. So all of this put together are the steps that you can take in dealing with threats. Let's look at questions before we proceed. This is one of the past questions, I think 2024, either May or November, that I can't remember. Now look at this question. It said you are the head of a team that is assisting let me say this before we proceed. Once you have a question in ICANN, always go to required first before you read the body of the question. Always go to required. And what is the required here? They say discuss the ethical and other professional issues that this man have on the assignment and the firm. So now let's read. You are the head of the team that is assisting ZAM Limited to comply with provisions of IFRS for SMEs. Your assistant team leader, Mr. Adams, has confided in you that in the course of carrying out your assignment, he met the daughter of Mr. Ajanle Koku, the managing director of ZAM Limited, and is keen to invite her on a date at the staff canteen before the end of the assignment for personal and corporate gain. Required. Discuss the ethical and other professional issue that this might have on the assignment. So the class is open right now. Let's look at this together. Class, what are the ethical issues here? Do we have any ethical issue here? If you say yes, what are the ethical issues that you can isolate from this place? Raise your hand and then we will call you. Let's go ahead, please. Anyone, please, that can try? Okay, Abdulaziz, go ahead.
Okay, good evening, sir.
Good
So
evening.
from the first one I can notice there is conflict of interest, sir.
Conflict of interest. Okay. Now, how I want you to answer this question is answer professionally. You need to be able to identify the ethical threats that are here, the ethical issues that are here. You understand me now? Isolate them one after the other and give me. You might make a sentence. Just look at the question and say, okay, from this place, this person have done this. This person, this is the ethical issue that is available with this line. Well, go ahead.
Okay,
Right.
sir. So from the line of Mr. Ajanle Koko, the managing director, who wanted to invite the daughter on a date, that would result to a conflict of interest in the
Okay.
sense that they are going there for a professional assignment, and adding a personal interest like going on a date might lead to an ethical issues of conflict of interest.
Thank you so much. Any other person I want to? I'm giving you 1 mark for that, Blazis. Please, you have my first 1 mark. Please take it. Take it. Quart up concept. Oh yeah. What?
Okay. Good evening, sir.
Good evening.
Okay, so to my own view on this, I felt there's a ethical issue there, which is intimidation. So from the part whereby the Mr. Adam is inviting the daughter of Mr. Ajani Koko on a date, after the date, it might lead to intimidation on how to get personal gain for Mr. Adams. So I felt intimidation is an ethical issue there.
Thank you. Okay. Any other person? Gochuku. Oh yeah. My student, go ahead. Let me. Hamza, go ahead.
Good evening, sir.
Good evening.
What I can deduce from the question is that there is going to be integrity. The integrity of the account, the team leader will be in question, will be questionable, because as an accountant, as you have said, the last one, we have to be a man of or a woman of integrity. So, given that it's going to go as a date with a person in charge, will be compromised. So as a result, he will not be sincere in his dealings. Thank you.
Thank you so much. Olabode, go ahead. Olabode Ayodele.
Hello, so good evening, sir.
Good evening.
What I notice as the ethical trait that will show up is that of the familiarity. Mr. Adams meeting the daughter of Ajanle Koko, they must have met somewhere before, and before you know it, there will be familiarity. The level at which they will relate now will be a threat to the team. So that's what I think will happen.
Thank you so much. All right, follow Shaw.
Good evening, sir.
Good evening.
So what I also feel is that the major issue here would be a familiarity threat. Because for him to be inviting the daughter of the Mr. Adams on the date, that's they are creating a familiarity threat there. You will not be able to act professionally because you want to act biased in making your decision.
Thank you so much. Akimbode.
Sir, good evening, everyone. So one thing I noticed also, apart from the familiarity that I was speaking about, was the self-interest thread. We could see that Mr. Aja, what's his name, Mr. Adams, is gonna use the assignment for personal and corporate gain. So definitely, self-interest thread will definitely sprung up in this moment. That's one thing I noticed, sir.
Thank you so much. All of us we have spoken well. But the question I want to ask is this. Evans, just hold on. In this particular question now, do we have the 5 threats in this particular question, or 2 or 3 or 4? Just raise your hand, I will call you. Okay. What do you think? Do you think we have the 5 threats here, or 4 threats, or 2 threats, or 3 threats in this particular question? All right, John. John Azeke. Okay, Akimbode, you can go ahead. Akimbode, go ahead.
Sorry, sir, I didn't know I was muted. So
Okay,
from what I can see, I think we have just 3, if I'm right. There's familiarity, yes, the familiarity, there's self-interest, and then the other one, what's the other one? I forgot.
Okay. We have all spoken well. Now, let me show you the professional way of answering this question. You see, when we say ethical issue, we are talking about threats. That's very, very important for you to take note of. We're talking about what? Threats. From this question, if you read very well, let's read carefully. We say, you are the head of a team. Mr. Adams, who is your assistant, confided in you that in the course of you carrying out the assignment, they send on a go one place, more on a go do audit. The order of your assistant, person where they assist you, the person assisting you, saw and met the daughter of the managing director of the company you are to audit. Confided in you, don't forget. And then the guy said they have gotten so close that he's inviting the girl to come and eat in the staff canteen, inviting her on a date at the staff canteen before the end of the assignment. And the essence of why he's inviting the girl is for personal and corporate gain. The threats that are here are enormous. True of us. True. So how do you answer? Now let's go. The threats that are in this scenario, let's just go directly. All of the what is it called? The code of conduct are threatened. Integrity is threatened. Objectivity is threatened. Is that also? Professional due care is threatened. Professional behavior is threatened. Is that also? Confidentiality is also threatened. All of the the code of conduct, the principles are all threatened. Because let's take them line by line so that you will understand. Objectivity threat, that is the conflict of interest that you all mentioned. The intention of Ms. Adams to pursue a personal relationship with the man create what we call a self-interest and familiarity threat, because his professional judgment will be compromised. there is no way the lady might also not be used by the father to gain undue advantage. And so that undermines the requirement of professional accountants to remain objective. That's number one. Number two, the integrity threats. As an accountant, it is that you should uphold honesty and be straightforward. But you seeking personal and corporate gains because of the association you are having with the family members of the clients will make you unethically wrong, and you cannot uphold your integrity. Now, what about the professional behavior? Is that the right thing to do as a professional accountant? Dating the manager director's daughter during an ongoing assignment is very inappropriate and very unprofessional. And then confidentiality. The risk of being able to keep the information secret and lip seal is very low. There is no way you won't disclose confidential information. In the process of you eating the canteen, the girl may ask you, have you see anything? What did you even see, sir? That's where you begin to discover, is that operation manager, the man just the chop on our money. The man is just eating you people's money. And, you know, like that, you have disclosed information to the third party, which is not part of what you should uphold as a professional. So the breach of confidentiality will also lead to, you know, breach of what is required as a professional, as it were. So all of these can be viewed as a threat. So we have what we call the self-interest threat will be there, familiarity threat will be there, intimidation threat will be there, as well as what is the other one now? Self-interest threat, intimidation threat, familiarity threat. Which other one again? Self-review will also be there. So majorly or minimally, we can say we have three or four of the threats that will be applicable in this particular question. We have all done well, but why I'm bringing this question up is anyhow you answer it in the exam, all that we need is you should be able to isolate the issue, the ethical issue there, and tell us this is the threat that you see. Now, if they go further and say you should provide a safeguard, that is when we begin to identify. You understand me now? Identify, consider the relevant ethical principles that you will breach, evaluate the alternatives that are available, apply safeguards, and act in the public interest. So that is that for that. I want to check. Okay, we have various questions also in this particular materials. Once you pay, you also get the material, like we told you when we are doing our orientation yesterday. So that is that for that. Now, another major issue is the independence and professional skepticism of those the Mr. Adams and the other person. This may not be an audit engagement, but independence of mind and appearance is very, very significant. And so therefore, there is no way a professional accountant will carry out the due care, will carry out the job with utmost due care without compromising if you don't have, you know, an independence of mind and independence of appearance. So meeting up with the girl is very, very, very wrong. Please take note of that. Now let's look at another question, as it were. You can snap this question. I want you to attempt it, and then you give me the answer on the WhatsApp platform. I want us to conclude as much as quickly as we can. Okay, I'm sure we have snapped it. So let's go to the conceptual framework. Very, very important. Another very concept that you need to.
Sorry, sir, we couldn't get the question. It was only the solution you showed, sir.
Okay, sorry, please. Let me go back. This is the question.
Thank you, sir.
All right. So let's go to the conceptual framework. The conceptual framework talks about, like I said earlier, it's just a manual that guides how standards are to be operated. You know, it's a theory or a policy guide as to how, you know, ISB set standard. We that are preparing and presenting financial information, how we are to apply it, and then how the users should understand the financial statement. It has 8 basic chapters. It has 8 chapters. Chapter 1 talks about the objective of general purpose financial statement, and the objective is to provide information that is useful to users of financial statements. So that is chapter 1. Chapter 2 talks about the qualitative characteristics of the general purpose financial statement. If we agreed, for instance, that the general purpose financial statement objective is to provide quality information for users to make adequate and informed decision, then what exactly will make the financial information to be of quality in terms of usage? That's what we are looking at in the chapter 2. And then we have 5 major qualities. These 5 qualities divided into 2 legs. We have the fundamental and then the enhancing qualitative characteristics. In other words, we have the core, the germane, the major characteristics that a financial report must possess. And that is what we call fundamental qualitative characteristics. And we have 2 of them. We have relevance and faithful representation. In other words, for information that is presented in the financial report to be useful, it must be relevant. That is to say, you can use it to predict the future of the entity, as it were, and you can use it to, you know, evaluate the past of the entity. Must be relevant for decision making. Number 2, I said the second one is a faithful representation. In other words, it must the information you are providing must be complete, must be neutral, must be void of ambiguity. It must faithfully be represented. That is the chapter 2, as it were. So fundamental characteristics, relevance, and then faithful representation. Then we have the enhancing characteristics. Enhancing characteristics is we have comparability. That is to say, information that you provided, we can use it to compare the entity's performance year on year basis, or entity to entity basis. In other words, if company A should provide an information, we should be able to use company A information to compare, we can compare the information of company A with other companies that are within the industry. And then we have verifiability. In other words, information you are provided should be verifiable. And that is where we have what we call, the fact that whatever you are putting down should have a source document. They should have source document that can be verified. Timeliness simply means that the information you are providing must be timely for quality decision and economic decision making. You cannot use, for instance, information of last year to make information figures of last year to make information this year. Why? Because the time value of money has a major role to play as well. The inflation rate is not the same thing. Interest rate, they are not the same thing. And so information that you are giving must be adequately timely. Then understandability. In other words, every information you are providing must be understandable by the user. Very, very important. It must be understandable by the user. I also have an acronym for this, and I call it FADA V COT. I call it FADA the court. Faithful representation, relevance, verifiability, comparability, understandability, and timeliness. Please don't forget, you can use it in your exam. That is that for that. Then chapter 3 talks about reporting entity and then the financial statements. Financial statement and then the reporting entity. Financial statements, we have components of financial statement to be 5. We have the statement of financial position, statement of profit or loss and other comprehensive income, statement of cash flow, statement of changes in equity, and statement of policy, which I always call the notes to the accounts. These are the 5 components of financial statement or types of financial statements. Statement of financial position, statement of profit or loss, statement of changes in equity, statement of cash flow, and then statement of policy, otherwise known as notes to the account. All of these statements put together, they form the types of statements. And then conceptual framework give us definition of those statements. And then we also have the reporting entity. A reporting entity is any entity that is mandated to report their financial dealing, or those that choose to report their financial activity within a financial year. They are the reporting entity. So reporting entity can either be a single entity or group entity. In other words, a reporting entity can actually be a standalone entity or a group entity. A standalone or a single entity simply means an entity that do not have group, that do not have a subsidiary, do not have operating segment, do not have a joint venture arrangement, do not have a associate. Example, Akimbode Nigeria Limited, is a standalone entity, no subsidiary, no associate, no joint venture arrangement and the likes. And then you have the group, like we have a Dangote group of company. That's a group entity. So a reporting entity can either be single or group in nature. That's what I'm trying to tell us. And then chapter 4 talks about the element of financial statement. The element of financial statement, there are 5. We have the assets, we have the liability, equity, income, and expense. That is the element of financial statement. Note that element of financial statement is different from components of financial statement. Components of financial statement are the types of financial statement. Elements of financial statement are the headings in the financial statement, which we know as asset, liability, equity, as well as income and expenditure, and expenses rather. So that is how they are. Then we have chapter 5 to be recognition and the recognition. It's talking about how an item should be recognized. I mean, the criteria that an item must fulfill for it to be recognized on the financial statement. There are 3 main criteria. Number 1, for any item to be recognized on the financial statement, they must meet with the definition. That is number 1. Number 2, they must be probable. They must be probable to, give what we call future economic benefit to the entity. That is, the probability of them generating future economic benefit to the entity is actually high. And number 3, the amount, or what is it called, the value of such item can be reliably measured. These are the 3 main recognition criteria. Number 1, meet the definition. Number 2, probable to generate future economic benefit. And 3, reliably measured, must be reliably measured. Do you understand it now? So that is how it is. And then the recognition. The recognition simply means when you are removing an asset, a liability from the statement of financial position. It simply means that once an item on the statement of financial position is no longer meeting the recognition criteria, you can remove it. You understand? You have to de-recognize it. That's what we call recognition and de-recognition. Remember, I said we have 8 chapters. Chapter 1 talks about the objective of general purpose financial statement. Chapter 2 talks about the qualitative characteristics. And chapter 3 talks about financial statements and reporting entity. Chapter 4 talks about the elements of financial statement. Chapter 5 talks about the recognition and the recognition. Chapter 6 talks about measurement, measurement of financial statements. When we talk about measurement, it talks about the calculation. How do you calculate the value? How do you calculate the value that you are to attach to the items that you are recognizing under the element of financial statement? We have 4 or 5 major bases, measurement bases. We have 5 measurement bases. That is to say, an item can be recognized or measured in 5 different bases, on 5 different bases. Number 1, on historical cost basis. When we say historical cost, that is the initial cost of that particular item, the initial amount that can be attached to that particular item. And that's historical cost. We have number 2 to be current cost. The current cost simply means the cost that you can identify with that item at that particular point in time. For instance, we have when we are doing our revaluation, an asset, for instance, the worth of an asset can appreciate and as well can depreciate. You understand now? So the current cost simply means when we are doing subsequent measurement of the asset, what do they have as value? You know, historical cost is used as the initial measurement stage. That is the first cost that you are attaching to the item. Then the current cost, the fair value, and the value in use, they are the subsequent measurement basis. So that current cost simply means the cost that can be identified with the item, if we are to pay for it, or if we are to settle it as it were. So we have the current cost, and you have the fair value. That is, the fair value is the amount that we are willing to pay if we are to sell an asset, or that we are willing to settle an asset, a liability, as it were. Then the value in use. What if you are to continue to use that asset? If you are to continue to use that, to recognize that liability, what will be the value in today's portion? That is, we are talking about the present value of the asset. The future cash flow of an asset, what will be the present value as at today? That's those are the measurement basis. And then we have chapter 7 that talks about presentation and disclosure. Talks about how items will be effectively communicated, classified, aggregated, and materially stated. So it talks about how to communicate, effectively communicate, you know, all of these items that you have in the ledgers, the trial balance. How do you communicate them to form a report that can be well utilized by the users? Then it talks about the classification. For instance, we have the statement of financial position. Under the statement of financial position, we have a presentation classification that talks about asset, equity follow, then you have a liability. And then in the statement of profit or loss, you have the income aspect, and then the expense, and then you have other comprehensive income. So that is that for that. That's chapter 7. Chapter 8 talks about capital and capital maintenance. Capital and capital maintenance. Capital simply means the amount that you put into the business, the amount that you invested into the business. It's as simple as that. There is no more to say in this one. So when we say capital, we are talking about the money or resources that a business uses to operate and to generate profit. So it's the investment that you put into the business. For instance, if you put 1 million naira into the business from your saving, that 1 million naira is your capital. Then what is capital maintenance? Capital maintenance, in a layman way, simply means that any amount that you are putting into the business, any capital that is your investment in the business, must be maintained at the end of every financial year before you can claim profit. In other words, if you put 1 million naira in the business, at the end of the year, you cannot say you are declaring profit if your 1 million naira is not maintained as the capital base at the end of the year. So it is a principle that a business should first keep or preserve its capital before it can declare any profit, as it were. It's as simple as that. And then you have two concepts of capital maintenance. That is, two approach that you can use to maintain your capital base at every point in time. We have the financial capital maintenance approach and the physical capital maintenance approach. The financial look at the monetary aspect, while the physical look at the production capacity aspect. In other words, the financial is looking at the monetary aspect. For you to say you are going to declare profit, you must first of all look at what you close with during the year, and what you open with, what you close it with at the end of the year, and what you open with in the current year, as well as any amount that you pay out as dividend or amount that you receive as from issue of share. Let me take that again, because I know you may not understand. Financial capital maintenance simply means that for you to say you have made profit, you must compare your capital base at the end of the year with the opening after you have adjusted for if you have paid dividend out or if you have any share issue. In other words, the formula is the closing capital minus opening capital minus any dividend that is paid during the year minus any new issue during the year. It will give you the profit for the year. In other words, under your profit or loss, under your state of financial position, under equity, you have what we call the share capital. The share structure there happens to be the share capital, the share premium, and then the reserves. That is what forms your capital. So for you to say you have made profit at all, this capital structure must be maintained. Look at this illustration. You start with 1 million naira, and at the year end, your net asset, which is also your equity minus liability, is 1.2 million. The 200,000 naira increase in profit is what we refer to as the money capital. The 200,000 naira excess is the profit for the year because you have been able to maintain your capital base. But let us assume that you now pay. Let's assume that you pay. Assume that you pay dividend of 200,000 naira. Let's assume so. Now you pay this dividend of 200,000 naira. It means that you cannot say you have made profit for the year. You cannot say you have made profit for the year. So the concept of capital maintenance is for you to say you have made profit for the year, your capital base must still be intact at the end of the year. Your capital base must be intact. In other words, you cannot declare profit until your capital base is maintained. And then using a financial physical maintenance approach, you compare your opening, your closing capital base with your opening capital base, and then you check if there is any dividend that has been issued during the year. You nil it off. If there is any issue during the year, you also nil it off before you can say you have profit. So you can be asked to determine profit. They will give you information, and then they will tell you to determine profit using the financial or monetary capital maintenance. And then the best way to do it is to look at the items. You understand in the question. Sometimes they may be silent. You understand? Okay, let me quickly explain before I will. So I will not forget my line of thought. Sometimes they may be silent. They will give you a question and they will tell you that you should use either of the approach to determine if the company or the entity have made profit. we have been able to define the financial capital maintenance now. Let's look at the physical maintenance. The physical maintenance on its own, like I said earlier, is looking at the level of capacity, the productive capacity. You know that you use assets to generate what is called to generate future economic benefits. Is that not so? And since you are using your asset to generate future economic benefit, it implies that your productive capacity, the production capacity of an entity at the beginning of the year must be maintained before you can say you have made profit for the year. In other words, if, for instance, you are producing at the beginning of the year, your asset is producing 10,000 units of goods, or as it were, at the end of the year, before you can say you have made profit, you must be able to identify or isolate or know or note that your production capacity is still maintained at 10,000. That is, you can still produce 10,000 units of goods at the end of the year, even after considering depreciation, wear, and tear. So if you have not been able to consider depreciation, wear, and tear, you cannot say you have made profit. Remember, depreciation is a fictitious value, which of course will also be used in the state of profit or loss before we arrive at our profit. And so if your production capacity is maintained, it means that you can say you have made profit. But if it is not maintained, you cannot say you have made profit. Look at this illustration. You own a machinery that is worth 1 million naira that produces goods. After a year, you have 1.2 million naira cash, but the machinery now costs 1.3 million. 1.3 million due to inflation. You can see. With this money that you have as cash, you have 1.2, but now the cost is 1.3. So if you are to replace, because look at it this way, the machinery worth 1 million, that's what you are using to produce at the beginning of the year. But at the end of the year, the worth of the machinery now is now 1,300. It means that the capacity, that is the worth of that asset at the beginning of the year, is not the same as at the end of the year. And now you only have 1,200 naira as your cash or as your profit, as it were. It implies that you cannot declare profit. You can't say you have made profit, because even the amount of money you have do not even cover the worth of that your asset at the end of the year. Do you understand it now? Is it clear enough? Hello, class. Are we together?
Yes, sir. Yes, sir.
Yes, it is. Yes, good to go, sir.
All right. So that is that for that. Why I'm explaining this is, it's been a while they ask question on on capital and capital maintenance. Very, very important that you should take note and do more practice and understand it. If you don't understand it, let me go over it again. Capital is what you put into the business, and it is very that your capital must be maintained. That's why we have the concept of capital maintenance. You must maintain that capital base every now and then. Please, very, very important. Now, there are two approaches that you can use: the financial and the physical. The financial is what IFRS advises that we should subscribe to, because the physical may not be permissible given the different level of approach in terms of estimation of depreciation, as it were, and inflation. So it is expected that as professional we may choose to use the financial capital maintenance approach, but they did not make it compulsory. You can choose to use physical, you can choose to use financial. Now, what's the difference between the two? The financial deals with majorly monetary value. You understand me now? It's looking at, before you can say you declare profit, what is your capital base at the end? What is your capital base at the beginning? Do you declare dividend during the year? Do you issue any share during the year? These are the core things that you look into before you can say you make profit. And you must be able to maintain your capital base. Now, let's give an example again. Let us assume, and we are talking about financial now, let us assume that your capital base at the beginning of the year is 1 million naira, And then at the end of the year, you now have what we call, you make a profit of 1.2 million naira. Now, you issue a dividend of 200,000 naira out. There are no issues during the year. Now, for you to say that you have declared profit for the year, you must be able to, number one, determine what exactly is the excess that is remaining if you remove your closing, what is it called? Your closing balance, which is your profit for the year, from the opening and from the dividend. That's what I'm trying to explain to us. I don't know if it's clear or I'm making this thing to look bogus. Are we still together?
Yes, sir. Go ahead, sir. Yes.
All right.
Yes, sir.
So that is that for that. So summarily, capital is what you put into the business. Capital maintenance ensure that profit is recognized only after you have preserved your capital structure. That's that for that. Financial, focus on money. Physical, focus on the ability to keep running smoothly. You also have a lot of questions in this particular material. And so that is that for that. I think with this, we have been able to do justice to the grade A of your class. And I believe that we've been able to add knowledge as it were. Any question? Please, I want questions.
Yes, sir.
All right, Mary Precious, go ahead.
Good evening, sir.
Good evening.
Sir, please, this capital gain, capital maintenance, financial maintenance, if the company, you are saying that if the company, even if they have made 1.2 million, which is higher, so far as
Yes.
they pay dividend 200,000 and they their money is just remaining the 1 million capital, that means they have not maintained it financially.
No, they have maintained
But
their capital base, but they have not made profit.
oh, okay. But if they
You
pay
see,
like 100,000 for dividend, that
they
means
cannot
they
say they
have.
have made profit.
Oh, thank you, sir. Thank you very much, sir.
So, see, the essence of this capital maintenance is, there is what we call the capital structure under equity. So you cannot say you have a capital structure under equity in your zone of financial position, because you know that the profit that you are also making, if there is no dividend, for instance, it will become what we call retained earning. In other words, it will improve and increase your capital base. So we are concerned about the fact that, are you issuing out dividend? You understand me now? If you are paying dividend, then you should know that part of the profit is where you are paying the dividend from. So you cannot claim that you have made so amount of profit if you are paying dividend from that profit. Is that clear enough? I'm sure it is clear. So in the
Yes,
absence
sir.
of
Thank
any
you,
other,
sir.
in the absence of any other question, I think we can actually call it a day, right? Any other question, please? Are we good to go?
Yes, sir. Good evening, sir.
Yes, sir. We are good to go, sir.
Good evening.
What of the material? This material now, is it when we would have paid that we'll get it or what?
Yes, once you pay, it will be given to you.
Okay, no problem, sir. Thank you, sir.
It's